There are moments in history when the financial heart of the world simply stops beating. Moments when the relentless machine of global capital grinds to a halt. These are not mere downturns. They are system failures. Black swan events that become legends. July 31st, 1914. As World War I began, foreign investors dumped American stocks to fund their war efforts. To prevent a complete collapse, the New York Stock Exchange made an unprecedented decision. They closed the market. It would not fully reopen for 4.5 months, the longest shutdown in its history. The machine was broken. September 11th, 2001. Before the opening bell, the world changed. The closure of the NYSE wasn't a market crash, but a national tragedy. When the markets reopened, the Dow plunged 7.1%. The final push into the early 2000s recession. October 19th, 1987. Black Monday. A day of pure, unadulterated panic. The Dow plummeted an astonishing 22% in a single session, vaporizing over $500 billion. A perfect storm of a weakening dollar, rising interest rates, and the dawn of automated program trading created a feedback loop of selling that overwhelmed the system. The crash was so severe, it led to the creation of the modern circuit breakers we have today. Automated kill switches to halt trading during a meltdown. World War I. September 11th. Black Monday. These are true market shutdowns. But when the news today screams shutdown, they're almost certainly not talking about this. They're talking about something else entirely, and understanding the difference is the first and most important glitch in the system you can exploit. Welcome to Dollar Glitch. In financial news, the word shutdown is a powerful tool for fear. But for a strategic investor, precision is everything. The term describes two fundamentally different events. Confusing them is like mistaking a thunderstorm for an asteroid. First, this has real consequences. National parks close, passport issuance sees delays, and federal workers face immense financial pressure. But here is the single most important fact in this entire analysis. During a US government shutdown, the New York Stock Exchange and the NASDAQ remain open. The banks operate. Your brokerage account works. The engine of capitalism does not stop. The fear of being locked out of your money is based on a fundamental misunderstanding of what a government shutdown actually is. Wall Street knows this, and now, so do you. The disconnect between the panicked headlines and the reality on the trading floor is an exploitable glitch. While the media portrays a government shutdown as a crisis, Wall Street has historically treated it as political theater. The data is conclusive. An analysis by JP Morgan states it plainly. Investors have historically treated shutdowns as non-events with no clear market impact. Let's look at the numbers. Carson Group analyzed the 22 government shutdowns since 1976. What they found should reframe how you view these events. During these periods of supposed chaos, the S&P 500 actually posted an average gain of 0.3%. The market, in aggregate, shrugged. During the 16-day shutdown in October 2013, the S&P 500 rose 3.1%. During the longest shutdown in history, the 35-day closure in 2018 to 2019, the market didn't just survive, it thrived, surging an incredible 10.3%. But the most powerful data is what happens after the drama subsides. 12 months after a shutdown ends, the S&P 500 was higher 86% of the time, delivering a stunning average return of around 13%. The glitch isn't in the market's code, it's in our perception. While headlines scream chaos, the data whispers opportunity. The real question then is not whether a shutdown will crash the economy. The data says it won't. The real question is, could there be a new variable in the equation today? Past stock number 1. The economic bedrock. Walmart. WMT. Our first fortress stock is a company whose business model is actively strengthened by economic downturns. That company is Walmart. The core thesis is simple. Walmart is counter-cyclical. Its identity is built on its everyday low-price promise. When financial pressure mounts, shoppers trade down. They become intensely focused on value. In this environment, Walmart's low prices become a powerful magnet, pulling in market share from everywhere. This isn't a theory, it's a battle-tested reality. The 2008 financial crisis is the ultimate case study. As the global financial system teetered, Walmart was having a record year. Its 2008 annual report hailed total net sales climbing 8.6% to a staggering $374.5 billion. Research from the period confirms Walmart's low-cost model was a blessing in disguise during the recession. This strength is backed by an unwavering commitment to shareholders. Walmart is a dividend aristocrat, having raised its dividend for over 50 consecutive years. This is a testament to its incredible financial stability and a clear signal that returning cash to shareholders is a core priority. The engine of its success is its legendary supply chain. Decades ago, Walmart cut out middlemen to deal directly with manufacturers, leveraging its immense scale to demand the lowest possible prices. Its financial health is robust. The debt-to-equity ratio is a satisfactory 46.5%, and its colossal operating cash flow easily covers its debt. An investment in Walmart is not just a defensive move. It's a proactive investment in a business designed to thrive on the very economic anxieties causing turmoil in the first place. Stock number 2. The unassailable healer, Johnson & Johnson, J&J. If there is one category of spending that is truly non-negotiable, it is health. People will not stop taking life-saving medication or buying basic first aid supplies. This principle of inelastic demand is the foundation of our second fortress stock, Johnson & Johnson. J&J is a global behemoth in healthcare, operating across innovative medicine and medtech. Demand for its This resilience is translated directly into one of the most reliable dividends in the market. J&J is a dividend king, having increased its dividend for over 60 consecutive years. This is a powerful statement about the company's cash-generating ability and its multi-generational commitment to its owners. The engine behind this stability is a relentless focus on innovation, both through internal R&D and savvy acquisitions of promising biotech firms to refresh its drug pipeline. J&J's financial health is impeccable, with an extremely low probability of financial distress. The company recently spun off its slower-growing consumer health division, Kenvue. The new J&J is a more streamlined company, focused on higher-margin pharmaceuticals and medical technology, making it not just a safe harbor, but a more powerful engine for growth once the skies clear. Stock number 3. The unseen essential, Procter & Gamble, PG. Our third fortress is a company whose products are likely within arm's reach of you right now. We're talking about Procter & Gamble, the undisputed king of consumer staples. P&G's defensive strength lies in its unparalleled portfolio of iconic brands: Tide, Pampers, Crest, Gillette. These are not discretionary luxuries. They are ingrained necessities in the daily lives of consumers. This creates an incredibly stable revenue stream that is largely insulated from economic shocks. People don't stop washing their clothes. The 2008 financial crisis illustrates this perfectly. P&G's fiscal 2008 annual report was a masterclass in strength. While others reported devastating losses, P&G announced that net sales had grown by 9%, and its diluted earnings per share grew by a remarkable 20%. P&G's commitment to shareholders is legendary. It is a dividend king of the highest order, having paid a dividend for over 130 years and increased it for more than 65 consecutive years. This is the gold standard of a reliable, cash-generating business. The engine for P&G is its mastery of brand management. It doesn't just sell products, it builds global brands into cultural touchstones. Stock number 4. The modern utility, NextEra Energy, NEE. For decades, utility stocks have been the quintessential safe haven, but the sector is transforming, and our fourth fortress stock is leading the charge. NextEra Energy offers the stability of a traditional utility combined with a massive growth engine in renewable energy. NEE's business is a powerful two-engine model. The first is Florida Power & Light, the largest electric utility in the U.S., providing a stable, reliable stream of cash flow. The second, more exciting engine is NextEra Energy Resources. This segment is the world's largest generator of renewable energy from wind and solar. This positions NEE at the epicenter of the multi-trillion-dollar global transition to clean energy. This hybrid model proved its mettle during the 2008 financial crisis. From the pre-crisis peak to the market bottom, the S&P 500 lost 51%. NextEra Energy's stock declined by only 24%, less than half the loss of the broader market. While not a dividend king, NEE is a dividend growth powerhouse, targeting an aggressive 10% annual dividend growth rate through at least 2026. As a capital-intensive utility, NEE carries a significant amount of debt, a key risk investors must acknowledge. However, this is managed by the highly predictable nature of its cash flows from its regulated utility and long-term renewable energy contracts. For NextEra, the long-term direction of government policy is a massive tailwind. Landmark legislation like the Inflation Reduction Act has unleashed hundreds of billions in subsidies for renewable energy. An investment in NextEra is a bet that this durable, growth-driving policy will always triumph over temporary political squabbles. Stock number 5, the loyalty fortress, Costco, COST. Our final fortress stock is a retailer, but its business model is unlike any other. For Costco, the most important product it sells isn't the bulk paper towels or the famous hot dog. The most important product is the membership card itself. The thesis for Costco is built around its membership-based model, which creates one of the most powerful moats in business. A traditional retailer makes its profit from the markup on goods. Costco makes the vast majority of its profit, approximately 65% of its operating income, from membership fees. This structure is a stroke of genius. Because its profitability is secured by this recurring revenue, Costco can sell its merchandise at razor-thin margins, capping its markup at a mere 14 to 15%. This creates a structural price advantage competitors simply cannot match. With global membership renewal rates consistently above 90%, this income is incredibly stable. Costco is not a dividend story. It is a capital appreciation play fueled by relentless and consistent earnings growth. A look under the hood reveals pristine financial health. Costco has an exceptionally low debt-to-equity ratio of just 0.20 and a sky-high Altman-Z score of 9.53, indicating negligible risk of bankruptcy. To truly understand Costco's power, you must appreciate its self-funding flywheel. Costco operates on a negative cash conversion cycle. It collects membership fees up front and then sells its inventory to members before it has to pay its own suppliers. This means its daily operations are funded by its customers and suppliers, not by debt. This unique capital efficiency has made it one of the greatest long-term compounding machines in retail history. We've analyzed the data, identified the risks, and deep-dived into 5 fortress-like companies. Each offers a unique blend of defense, income, and growth, designed to survive a period of uncertainty. Walmart is the counter-cyclical bedrock. Johnson & Johnson is the unassailable healer. Procter & Gamble is the unseen essential. NextEra Energy is the modern utility. And Costco is the loyalty fortress. To help you decide which aligns with your strategy, here's a comparative snapshot.